$4 trillion vanished in a single day. Gold and silver markets just experienced their most violent collapse in over 4 decades. Silver plunged 31% on Friday, its worst day since March 1980. Gold crashed nearly 11%, falling from a record high of $5,600 per ounce to below $4,900. And then on Monday, the bleeding continued. Another $400 to $600 wiped off gold prices. Silver dropped an additional 12%. In total, over 3 days, more than $10 trillion in market value has been erased. That's 5 times the entire market capitalization of Bitcoin. That's more than half of US GDP. Let's get into the details in today's video. Welcome back, everyone. Thank you so much for joining me. Thank you for being here. Please make sure that you are subscribed to Solando Opinion on YouTube and follow us on social media for more exclusive content. I would absolutely love to see you there. Links are in the video description below to get connected. Just last week, gold and silver were the hottest investments on the planet. Investors were piling in. Retail traders in Australia increased silver ETF purchases by 1,000% compared to the previous year. In India, people lined up at jewelry shops to sell their gold. In New York's Diamond District, there was absolute pandemonium as dealers scrambled to handle the surge in trading volume. Gold hit an all-time high of $5,600 per ounce on Thursday. Silver reached $122 per ounce, levels not seen in decades. The rally seemed unstoppable. Everyone was talking about safe havens, currency debasement, geopolitical tensions, and the decline of the US dollar. And then, overnight, it all came crashing down. The catalyst was a name: Kevin Warsh. On Thursday evening, news leaked that President Donald Trump would nominate Kevin Warsh as the next chairman of the Federal Reserve, replacing Jerome Powell when his term ends in May 2026. And markets reacted instantly. By Friday afternoon, the precious metals market was in freefall. This wasn't a normal correction. This was a liquidation cascade, a violent unraveling of one of the most crowded trades in financial history. Let's talk about who Kevin Warsh is and why his nomination triggered this chaos. Warsh is a former Federal Reserve governor who served from 2006 to 2011 during the global financial crisis. He was deeply involved in designing emergency programs to stabilize credit markets back then. But Warsh emerged from that era as a Fed critic. He opposed aggressive quantitative easing. He warned about inflation risks. He argued that keeping interest rates too low for too long would distort markets and create asset bubbles. In Fed jargon, Warsh is what they call a hawk. That means he favors tighter monetary policy, higher interest rates, and a smaller Fed balance sheet. He believes in hard money. He believes in discipline. And that's the exact opposite of what gold and silver investors had been betting on. For months, the precious metals rally was fueled by expectations of continued Fed rate cuts, a weakening dollar, and fears that central banks would debase currencies through endless money printing. Gold and silver were supposed to be the ultimate hedge against that. But Warsh's nomination flipped the script. Markets suddenly priced in a very different future. A future where the Fed maintains its independence. A future where rates stay higher for longer. A future where the dollar strengthens instead of collapses. And in that future, non-yielding assets like gold and silver become far less attractive. Now let's talk about what happened on Friday, January 31st, 2026. It started in Asian trading hours. Gold began sliding, silver followed. By the time US markets opened, the sell-off was accelerating. And then in the afternoon, panic set in. Spot silver plunged 28% to $83 per ounce. Silver futures crashed 31.4%, settling at $78.53. That was the worst single-day decline since March 1980, when the Hunt brothers' attempt to corner the silver market famously collapsed. Think about that for a second. This was a 44-year record. Gold wasn't spared either. Spot gold shed 9%, falling to around $4,195 per ounce. Gold futures dropped 11% intraday, the sharpest decline since 1983. The immediate trigger was Warsh's nomination. But what turned a sell-off into a rout was market structure. And this is where it gets really important. Gold and silver markets today are heavily intermediated by banks, ETFs, futures markets, and algorithmic traders. Many positions are leveraged 50 to 100 times. When prices started falling, margin calls hit instantly. Traders who had borrowed heavily to buy gold and silver were forced to sell, and that forced selling pushed prices lower, which triggered more margin calls, which caused more selling. This is what's called a liquidation cascade, and it feeds on itself. On top of that, the CME Group, which operates the COMEX Futures Exchange, made a critical decision. On Friday, they announced they would raise margin requirements for gold and silver futures. For gold, margins were increased from 6% to 8%. For silver, margins jumped from 11% to 15%, and in some cases as high as 16.5%. What does that mean? It means traders needed to put up more cash to maintain their positions, and many couldn't. So they were forced to close out, adding even more selling pressure. The CME said this move was necessary to protect the clearinghouse from collapse, as prices had surged to extreme levels. But the timing was brutal. It essentially ended the era of cheap leverage speculation in precious metals. And there's another factor that amplified the crash: ETF flows. Exchange-traded funds that hold physical gold and silver saw massive outflows. Trading volume in major gold ETFs surged to the highest levels in months. Silver ETFs were hit even harder. In India, silver ETFs crashed 20% and hit lower circuit breakers, meaning they couldn't trade because there were no buyers. Investors who wanted to sell couldn't find anyone to sell to. Liquidity completely dried up. At the same time, the US dollar spiked higher. The dollar index rose about 0.8% on Friday and continued climbing Monday. A stronger dollar makes gold and silver more expensive for foreign buyers, which reduces demand. And it also undermines the narrative that the dollar is collapsing. If the dollar is strengthening, why hold gold as a hedge? Now let's put this in perspective. Over the course of 3 days, from Thursday's peak to Monday's lows, gold fell from $5,600 to around $4,400 before recovering slightly to $4,650. That's a decline of more than 20% from the peak. Silver crashed from $122 to as low as $78, a drop of nearly 36%. In dollar terms, gold lost approximately $7.4 trillion in market value. Silver lost $2.7 trillion. Combined, that's more than $10 trillion erased. To put that in context, the entire cryptocurrency market is worth about $2.7 trillion. Bitcoin's market cap is around $1.5 trillion. So in 3 days, precious metals lost the equivalent of nearly 7 Bitcoins. But here's what makes this even more interesting. Despite this historic crash, gold is still up about 7% over the past month and up nearly 69% year over year. Silver is still up 8% monthly and 163% annually. So this wasn't a collapse from some baseline. This was a correction after an absolutely parabolic rally. And that rally was fueled by some very specific factors. First, geopolitical tensions. The world felt unstable. Trump's tariff threats, conflicts in the Middle East, tensions between the US and China, concerns about government debt levels, all of these pushed investors towards safe havens. Second, speculation. Retail investors, particularly in China and Australia, piled into gold and silver like never before. Chinese speculators, according to Bloomberg, played a massive role in driving prices higher, treating metals like momentum trades rather than long-term hedges. Third, central bank demand. Central banks around the world have been buying gold at record levels, diversifying away from US treasuries. And fourth, technical indicators. Gold's Relative Strength Index, or RSI, recently hit 90, its highest in decades. That's a sign of extreme overbought conditions. When RSI gets that high, corrections are almost inevitable. One analyst described the gold rally as a classic air pocket after an extraordinary run. Another said it was a crowded trade that became too stretched. And when everyone is leaning the same way, even good assets can sell off violently when positions get unwound. Now, there's also a darker theory circulating. Some analysts, particularly in Poland, are arguing that this wasn't just a natural correction. They claim it was a rescue operation by the financial system. Here's the theory. Major investment banks, including JP Morgan, had built massive short positions betting that silver's rally was unsustainable. But when silver hit $121 per ounce, those shorts were deeply underwater. Unrealized losses exceeded $10 billion, with JP Morgan alone facing more than $5 billion in losses. And then, right at the market bottom, JP Morgan allegedly closed its short positions. The timing was perfect, almost too perfect. Critics argue that the CME's margin hikes and the sudden collapse weren't coincidental. They suggest it was coordinated to bail out over-leveraged banks. Now, I can't confirm or deny that theory, but what I can say is this. The timing was extraordinarily convenient for anyone who was short silver. And the speed and violence of the move suggests something more than just natural profit-taking. So what happens next? Well, analysts are divided. Some believe this is just a healthy correction and that gold and silver will recover. They point out that the fundamental reasons for owning precious metals haven't changed. Government debt is still at record levels. Geopolitical tensions remain high. Central banks are still buying gold. And if the Fed does cut rates later this year, that could reignite demand. Christopher Forbes from CMC Markets says gold could revisit recent highs if the Fed continues easing, while growth and inflation stay uneven. He also notes that renewed dollar weakness or confirmation that Warsh will be dovish could bring buyers back. But others are more cautious. They warn that if Warsh follows through on tighter monetary policy, if the dollar continues to strengthen, and if geopolitical tensions ease, then gold and silver could face further downside. And there's also the question of leverage. How much forced selling is still left in the system? Are there more margin calls coming? Nobody knows for sure. What we do know is that volatility is going to remain extremely high. In the short term, gold and silver prices will be dictated by two things. First, further clarity on Warsh's policy direction. Will he really be as hawkish as markets expect, or will political pressure force him to be more accommodative? And second, the strength of the US dollar. If the dollar keeps rising, metals will struggle. If the dollar weakens, metals could bounce back. For retail investors who got caught in this, the pain is real. ETFs are locked in circuit breakers. People can't sell, leveraged traders have been wiped out, and the psychological damage is significant. Many investors who bought near the top are now sitting on massive losses. In India, investors are being advised to close positions as quickly as possible if they used leverage. For those holding physical gold or unleveraged ETFs, the advice is different. Some analysts say hold and wait for a recovery. Others say cut losses now before it gets worse. What's clear is that this episode is a brutal reminder of how dangerous crowded trades can be, especially when leverage is involved. Gold and silver had become speculative assets, not just safe havens. And when speculation drives prices to extremes, corrections are inevitable. The question now is whether this marks the end of the precious metals bull market or just a painful reset before the next leg higher. One thing is certain, Friday, January 31st, 2026, will be remembered as one of the most dramatic days in precious metals history. $4 trillion wiped out in a single session. Silver's worst day in 44 years. Gold's biggest drop in decades. In a financial system that once again showed just how fragile it can be when everyone rushes for the exits at the same time. Stay tuned. I will keep you updated as this story develops. Thank you very much for watching. I hope this video was informative. Please support the channel by liking, subscribing, and sharing this video with others who might find it interesting. I appreciate every single one of you who watches and engages with this content. I look forward to seeing you in the next video. Take care.